Every 3 months, the two most important indexes in American finance, the S&P 500 and the Nasdaq-100, rebalance. Companies come in, companies go out, and this week's changes tell you more about where the economy is heading than almost any piece of economic data. Because the June 22, 2026 rebalancing was unlike any before it. Almost every company added to these indexes has one thing in common: artificial intelligence. In the next 10 minutes, I'm going to break down exactly which companies were added, which were removed, what this rebalancing means for your retirement account, and why the concentration of AI in America's core indexes is both the biggest opportunity and the biggest risk in the stock market today. Let's start with the Nasdaq-100. The Nasdaq-100 added 5 companies and removed 5, effective before trading opened this morning. The 5 companies added: CoreWeave, Astera Labs, Nebius, Teradyne, and Rocket Lab. Look at that list carefully. CoreWeave rents GPU cloud computing capacity. Its entire business is providing the raw computing power needed to train and run AI models. Astera Labs makes the connectivity chips used inside AI servers, the high-speed links between processors. Nebius runs AI cloud infrastructure. Teradyne tests semiconductors and builds robotics automation. And Rocket Lab provides space launch capability, increasingly used for satellite AI applications. This is not a coincidence. This is a deliberate shift. The 5 companies removed were Charter Communications, Cognizant Technology Solutions, Inzoomed, Verisk Analytics, and Zscaler. Telecom out, Legacy IT Services out, Biotech out, Data Analytics out, Cybersecurity out. AI Supply Chain in. The message from the Index Committee is unmistakable. The economy is reorganizing around artificial intelligence, and the Nasdaq-100 is being rebuilt to reflect that reality. The S&P 500 made similar moves. It added Marvell Technology and Flex, replacing Pool Corporation and Campbell's company. Marvell designs custom semiconductors used in data centers and AI systems. Flex is a global electronics contract manufacturer, producing the physical hardware that AI runs on. Pool Corporation sells swimming pool supplies. Campbell's makes soup. The S&P 500 just swapped soup and pools for AI chips and servers. Now, why does this matter to you? If you own an index fund, a total market fund, an S&P 500 fund, a Nasdaq-100 ETF like QQQ, you now own more of these AI companies automatically. You didn't have to make any decisions. The Index Committee made it for you. And the numbers show this concentration is accelerating rapidly. Since AI stocks began their massive run in 2023, the S&P 500 has gained 142%. But here's the stat that should stop you cold. Without AI stocks, the S&P 500 gained only 16% over the same period. AI companies drove nearly 90% of the index's total return. That's extraordinary concentration. It's also extraordinary risk. When a handful of companies, Nvidia, Microsoft, Apple, Meta, and now the newer entrants like CoreWeave and Marvell, drive the bulk of index returns, the index becomes a bet on those companies staying dominant. If any of them stumble, the impact on index funds is immediate and amplified. History has seen this before. In the late 1990s, technology companies dominated the S&P 500 and the Nasdaq. When the dot-com bubble burst in 2000, the Nasdaq fell 78% from peak to trough. That doesn't mean AI is a bubble. The difference today is that these companies have real revenues, real earnings, and real products that businesses are already paying for. CoreWeave generated over $900 million in revenue in 2025. Marvell's AI chip revenue doubled year over year. But it does mean that if you own a passive index fund, you own more AI than you probably realize. And the performance of your retirement account is now more correlated to the AI sector than at any point in history. What should you watch? First, Nvidia's earnings next month. Nvidia supplies the GPUs that CoreWeave rents and that power Nebius's cloud infrastructure. Nvidia is the upstream supplier for almost every company added to these indexes. If Nvidia's demand signals change, it cascades. Second, watch for antitrust scrutiny. The Department of Justice and the Federal Trade Commission have both opened investigations into AI computing concentration. If regulators move aggressively against the biggest AI players, the entire sector could reprice. Third, watch the 10-year Treasury yield. Higher yields compress the valuations of growth stocks. AI companies trade at high multiples of earnings. They're particularly sensitive to rate increases. The bottom line, America's most important indexes are now AI indexes. The rebalancing of June 22, 2026 made that official. That's either the most exciting thing you've heard this year or the most concerning, possibly both. Subscribe for daily coverage of the market moves that are reshaping the economy. We post every single day so you stay ahead of what's coming. I'll see you in the next one.